All right, so welcome back to the Ambitious Stars podcast. This is episode 202, all about the Benjamins. And today we're going to be talking about finance. We're going to be talking about taxes. And I have my personal accountant and somebody that I've actually been talking to quite a bit in the last 2-3 months about just taxes and finances and what I can do to be better about it. We have Alex here.
Good to be here.
Ooh, yeah.
Thank you.
I want to start off by just letting you kind of introduce yourself and tell us a little bit about how you got to where you are now.
Yeah, so my name is Alex. I am a CPA. Been in this profession for approximately 5 years. I got started by working up in a firm in Deerfield and just decided that wanted to do it for myself and wanted to help people through my own practice. And so I broke out and been doing it ever since. I actually didn't plan on being an accountant. I planned on going into either medicine, law, or engineering. So coming from like an Eastern European background, you're kind of told like you got to do one of these 3 things to be financially stable. And I was going to do physical therapy because I wanted to be in medicine, but I'm not very good with blood. I'm very squeamish. So just on a whim, I decided to do accounting because I had a knack for law and numbers. Did not know it would take me down this road of taxes, but I'm very, very grateful that it has because I've had the pleasure of working with some incredible individuals, incredible businesses, helping them, and honestly learning on the way. As I've been helping them as well. So it's a little bit about me. Yeah.
Cool. So we're going to hop right in. And I just want to start off, why do most people fail with money?
Why do most people fail with money?
Or some of the reasons why people fail with money.
So I think there really comes there's 3 pillars that people need to remember when it comes to personal finance or financial planning and building your wealth and taking care of your finances. And those 3 pillars are debt, taxes, and investing. And I feel like we live in a world that is very materialistic and everything is right at your fingertips. You know, the next new shiny object or event is always being waved in front of you, right? You're being guided to purchase the next best thing, to try this, to try that. And I feel like we get sucked into this world of always having to spend money on experiences and goods, and we don't take care of the things that set us up for the future and prevent a lot of headache and trouble in the present. So when you think about debt and bills really fall into that as well. So, you know, when payday comes or you're running your business, one of the things you always have to make sure of is you're taking care of your bills. You're paying your mortgage, your rent, utilities, and then also consumer debt is another big one. So credit card debt, personal debt, even business debt, that is a key component to staying afloat financially because if you don't, fees come with it, higher interest comes with it. Nobody reads the fine print when you sign up for something. And then what happens is you start getting hit with higher interest, higher fees, and now you're trying to stay afloat, paying everything down while also having interest in fees on top of that. Another big one is taxes. Nobody likes taxes, and me as a tax preparer and a CPA, it's not like I like paying taxes, but I know that if I don't take care of my taxes, it's going to come back to bite me because the IRS, the states, and all the various different agencies, they want their money. They want taxpayers to pay the right amount of taxes. And when people don't do that, when they neglect it, it really comes back to bite them because there's penalties, there's fees, there's interest that are assessed to you when you don't pay, when you don't file your taxes on time. And I'm sure we could talk about that later, but in a gist, if you don't pay your taxes, it's not like you just get out of jail free card. You're sucked into it and you're gonna have to make up for it somehow. So debt, taxes, and the last key component is investing. So what are we doing now to set ourselves up for the future, right? So when you get paid, when you're earning your money, are you setting aside money into the appropriate high yield savings account? Are you investing money for your retirement? Because that money compounds over time. And before you know it, 20, 30, 40 years have gone by. Life has gone by, and retirement age is coming up. Have you set yourself up for the future in your early years to make sure that you can retire comfortably? And people make it to be something that's very difficult, but setting aside a little bit of money every single month and putting it towards a Roth IRA or a 401k at work, or just even in the stock market. If you don't want to do that yet, there's savings accounts that provide higher interest yields. So setting that money allows your money to effectively grow over time without you having to do anything for it. And so I would say the three key pillars to making sure you stay afloat and why people get in trouble with finances is they don't focus on those three key components, being debt and bills, taxes, and investing.
Cool. Yeah, I think most of the people who probably will be watching this are freelancers. We're going to wait for this ambulance to pass by. Nice. So I feel like most of the people who will be watching this are freelancers of some sort. And there's always been this phrase, struggling artists. And, with that comes, we're just trying to work to get by, or we're trying to essentially stay afloat to continue to freelance. I think something we talked about in the last episode was that freelancing isn't as shiny as most people make it seem. Having to pay bills while doing something that you like can sometimes get overwhelming. And so all of that being said, when people are paid, what should be essentially their breakdown? And I know a lot of people might only have enough just to get by, but what should people start to work towards, whether that's how much percentage of that money should be saved, or what money should they be putting aside for certain things?
Yeah, entrepreneurship is no easy task. It's difficult enough financially if you're just, an employee, but when you take on that entrepreneurship challenge, it comes with a whole bunch of different financial struggles as well. You're juggling a lot more things than you perhaps were when you were just an employee. So I understand that a lot. And I would say it starts with this. It starts with planning and budgeting. And if you're not planning and budgeting, no matter what percentages somebody gives you, there's no rule of thumb. There's no set percentages. Everybody's different because everybody has different expenses, ways of life. Some people are just naturally more extroverted. They thrive on going out. So how do you meet that while also taking care of your finances? And so it does start with budgeting and kind of cash flow. So if you're getting paid as an entrepreneur and you know that in a month rent is due, if in 2 months you're trying to save up for the next piece of gear to advance your profession, are you saving for that? Or are you taking that money and using it for something that in the current moment is going to provide you satisfaction or a thrill, whether it's a purchase, an event, you name it. So maybe sometimes you have to take a step back and look at your own current spending habits and say, well, when I look at my credit card statement, for example, am I just spending money to spend money, or can I save a little bit to propel myself forward in the future? So if there are expenses, for example, that you can hone back on just a little bit, what are you going to do with that money? Are you just going to have it sit there, or are you going to put a plan to it? Because when money just sits there sometimes, we just, it builds up, it piles up, and then we think, oh, we have all this cash, like I'm cushioned, I'm safe. But if you put a plan to your money, it gives you confidence and incentive to kind of approach that goal and go forward for that goal. So if you're going to scale back expenses, for example, look at any of the money that you're saving and say, well, hey, 10% of this I want to put towards my retirement because I know that one day I'm going to have to stop working. Some of this money is going to have to go towards paying down debt, maybe if you have accumulated credit card debt, right? Some of that money can also go to just setting it aside for a future expense for equipment, purchasing a studio perhaps, something to advance your profession. Put a goal for your money. Put goals for what you want to achieve in your business. And it's hard because most of us don't want to look at our finances. Sometimes we just like to swipe the credit card. We just like to go about life. And then the end of the month comes, we're like, well, maybe I can pay the credit card. Maybe I can't. On to the next month. And so it's like almost human nature sometimes not to want to look at your spending habits, but you have to. You have to look at it and say, here are the areas where I can scale back, and here's what I'm going to do with my money. So general rule of thumb, let's say 5 to 10% of what you save, set it aside into a retirement account. You have to understand your tax situation, where you fall in line with that. And that's huge for working with a CPA, just doing tax planning, because if you don't understand where you fall in terms of tax brackets and tax rates, you're gonna get in trouble because you're either over saving for it, and you could have used that money for something else, paying down debt, advancing your business, or you're saving too little, and then come tax time, you don't have the required funds to pay your taxes, and now you're accruing interest and penalties on that money. So some percentage, and it's different for everybody, should go to investing. Some percentage should go towards saving for taxes, and then another percentage of that money should be focused towards paying bills, paying down credit card debt, and at the end of it, you know that you've taken care of as much as possible to live a financially stable life, and the remainder of your money is what you get to utilize for events, products, whatever it may be, just for daily enjoyment.
Got you. So you talked about tax breakdowns and tax brackets. I want to go into, I guess, your average entrepreneur. And I'm just going to throw out some numbers here, and you can kind of, I guess, go from there. But I would say the average entrepreneur probably makes anywhere from $50,000 yearly on the maybe higher end to about $100,000. So within that tax bracket, what would percentages be for that, and what should people be saving to go towards taxes if they aren't S corp, or they're just simply a self-employed LLC, sole proprietorship?
Yeah, good question. So if you're not an S corporation, if you are just a sole proprietor, you just open up an LLC and you haven't done any other kind of tax or legal restructuring, you're gonna fall in line with 4 different key tax rates that you need to be aware of. Those being the federal income tax rate, which that is a bracket system. So as you earn more money, you pay more taxes. And so the system is, the first, let's say 20,000 is taxed at 10%, then the next 40,000 is taxed at 12%, 14, and it goes on and so forth. So you have the federal income tax rates. You have state income taxes, which in the state of Illinois is 4.95%. That is a flat tax rate. And then you have Social Security and Medicare. And this is the one where people really get tripped up, because a lot of entrepreneurs, they start after being employed somewhere. So they've worked like a W-2 job, and then they're like, hey, I want to explore my creative side. I want to be an entrepreneur and do this and that. I want to start my own business. And they often forget that as a business owner, as a self-employed individual, freelancer, whatever you want to call it, your Social Security and Medicare taxes are doubled right away. So as an employee, you pay 6.2% Social Security, and then you pay 1.45% for Medicare. Your employer, your boss, he or she covers the other half, so you're not responsible for it. When you become self-employed, the onus falls on you. You are both the employer and the employee in a sense. So if you just think about the minimum case, kind of we talked about $50,000 or so, right there you are taxed at about maybe 10% federal income taxes. You're taxed at 4.95% state income taxes. We're already at 15. And then you have Social Security and Medicare, which approximately 15%. There's 30% of your money right there as an LLC owner. Now, that's on profit. So maybe you have expenses, you can bring that down. There's tax or there's benefits to being a self-employed individual to bring your overall revenue down. But at the end of the day, if you're just a sole proprietor, if you're just an LLC, you have to meet 4 pretty hefty tax rates. And a lot of people, they don't want to think about that tax side until tax time. And that's the IRS doesn't just give you a freebie, right? As a W-2 employee, you pay your taxes throughout the year. That paycheck comes in, you've already paid your taxes. And so when you go to file your tax return, you're either assuming all else, there's nothing else, and it's a very simple return, you're either going to get a very small refund or potentially a very small balance due, because you're just kind of equalizing at the end of the day, you're truing up to the right balance. Well, as a self-employed individual, you're not doing that effectively every 2 weeks or every month through a paycheck. The onus falls on you. And so the IRS and the states, they want their money throughout the year. They don't want to just wait till tax time for all this money to come in from taxpayers. And so what they've effectively done is they've said there's 4 quarters throughout the year where you, as a self-employed individual, are responsible for calculating and figuring out what you're going to owe in taxes for that quarter, so that come tax time, you've paid in, let's say, a good portion of your taxes, and maybe you have to make up a little bit, or you're going to get a small refund. So self-employed individuals, freelancers, there's 4 different key tax rates you have to be aware of. And it could be as high as 30% for somebody that even just starting out. And you also have to remember that you don't just get a pass to pay that come April. You have to pay it throughout the year generally to avoid interest and penalties. They're called underpayment of tax penalties, because the IRS effectively, and the states, they penalize you for not paying in your taxes throughout the year, because to them, they can do a lot more with the money throughout the year than they can with just everything coming in at once. So when you think about percentages for saving, unfortunately, that 20 to 30% is a generally good rate to think about as a self-employed individual, maybe scratching $50,000. As it goes through all the deductions and you're actually doing your return, there's a lot of benefits that come your way to reduce that. But as a general saving, like a rule of thumb perhaps, I mean 20 to 30% is not a bad idea. So,
got you.
Yeah.
So for the people who are probably listening, just like 30%, that's a lot. I mean, I'm listening to that. That's a lot. If you're making 100,000, that brings you down to 70 to live off of, have your expenses and things of that nature. What can people do to effectively eliminate that? Or not eliminate it fully, but like eliminate it to a percentage where it's a little bit more in their favor?
Yeah, to eliminate it fully, I don't think on this podcast I can give that information, but could get in a lot of trouble, but there's ways. To eliminate it to a point where it's maybe more sustainable or something somebody's more comfortable with, there's a lot of tax planning opportunities. So there's deductions you can take for a self-employed individual, but before you get into the deduction side, when you're making $50,000, $60,000 of profit, it's one of the most advantageous tax planning opportunities available to freelancers, self-employed individuals, is taking your sole proprietorship, your LLC, and converting it to what's called an S corporation. So it's a small business corporation. And what that effectively does is it tackles 2 of the key tax rates we talked about. So if you remember, the federal income tax and the state income tax, if you go from an LLC to an S corporation, those don't generally benefit too much. There are some benefits, but that's not really where the focus is. And so when you convert from an LLC to an S corporation, what you're really tackling is Social Security and Medicare. And so here's kind of the beauty of S corporations. As a freelancer, as a self-employed individual without having elected S corporation status, you're going to get hit with all 4 tax rates to the fullest extreme, right? As an S corporation owner, federal income tax, state income tax, let's just keep them the same. What happens now with Social Security and Medicare is the IRS says when you become an S corporation owner, you are effectively an employee of your own company. So yes, you're an owner, but you also are an employee, and you have to issue yourself payroll. And so this is something that most of us are familiar with: W-2s, pay stubs, payroll. So let's just do a quick example. If you have $100,000 of profit, right? Maybe $150,000 revenue, $50,000 of expenses, $100,000 profit. No S corporation election. You're just a regular LLC. You're getting hit 15% Social Security, Medicare, federal income tax, state income tax. Now we're an S corporation. Federal income tax, state income tax, relatively the same. Social Security and Medicare is only paid to the extent that you issue yourself a payroll. And the IRS guidance is that S corporation shareholder employees must pay themselves a reasonable compensation. And that's a huge gray area within the IRS.
Yeah, talk about that.
Of what reasonable compensation is. They have guidelines for how to determine it, right? So if you have $100,000 of profit and you issue yourself a $5,000 W-2 for the year, slim chances that's actually reasonable compensation. But let's just say, for example purposes, you issue yourself for the entire year a $20,000, $30,000, $40,000 W-2, and you can justify, well, that's reasonable compensation for me as the owner. What you've effectively done is you're only going to pay 15% Social Security and Medicare up to that W-2 wage. So you're gonna pay it up to whatever reasonable compensation you issue, whether that was a $20,000, $30,000, or $40,000 W-2. And now there's this gap between the $100,000 of profit and the W-2 where you're saving 15% on Social Security and Medicare taxes. So if you take that, if we did a $30,000 W-2, you just saved $70,000 where you don't have to pay Social Security and Medicare tax. So you can go through the calculation, but that's quite a bit of money. It's quite a bit of taxes that you get to keep for yourself and invest it for whatever it may be. Tackle those three pillars of financial planning or advance your business further. So the reason as to why it doesn't always make sense to just elect S corporation as soon as you open up a business, as soon as you become a freelancer, is because there's a lot of regulations, there's a lot of rules that you have to follow to make sure that you do it correctly. And with that, obviously comes a higher cost. So making sure you do it correctly requires working with an accountant, a CPA, even just a tax preparer, just to make sure that you are meeting all the requirements. Look, the IRS knows how beneficial S corporations are. And so they're gonna make sure that they put in the right rules in place to make sure people are following everything to get that tax benefit. So some of the regulations are, you need proper corporate books and records. When you become a corporation, you have to follow corporate rules to avoid things like piercing the corporate veil. So good books and records is a key factor. You have to run payroll. You have to make sure you are running payroll for yourself to show that I've calculated reasonable compensation and I'm paying myself regularly, whether that's 2 weeks, once a month, perhaps even once a year for some people. So that's, then you have a whole business income tax return that has to be filed. So there's a lot of things that have to get put in place to make sure that you are following the S corporation rules properly. And unfortunately for us as taxpayers, is one of the biggest things the IRS is focusing on and has been focusing on, but really is going to tackle into the future, is S corporation owners, because the IRS knows that a lot of people get by with this whole reasonable compensation. They don't do it properly. They don't really pay themselves a reasonable compensation. They skim the surface, get by. They also know that a lot of S corporation owners aren't meeting all the requirements that they should be for corporate rules. And so you hear a lot of this stuff like the IRS is hiring 87,000 agents. They're investing millions of dollars into the IRS. And it worries me for the people that just try to get by with this kind of stuff. When you want to do an S corporation, do it properly. Do it properly so you don't get in trouble later by not having done the correct things. So There's a lot of benefits, that being one of the biggest benefits available to you as a freelancer. It's not always the right answer. If you're in a partnership with somebody and you're starting a business with 2, 3, 4 people and more, S corporations don't always make sense. There's a lot of rules regarding them on how you handle money, and the more people that are in your business, the less advantageous an S corporation can be. A simple partnership may make the most sense, but yeah, that's probably the best tax planning opportunity available to freelancers, is tackling that Social Security and Medicare taxes when you get to a point in your business where it makes sense to go take that extra step.
Got you. So for me, I found you on Instagram, and at that time I had maybe like 1 year of back taxes for the year 2021. And honestly, I think I was just scared of taxes, and like how much money I would have to pay. Cause I think the year before that, the number that I got hit with was just like nuts to me. And I think now I kind of see that I kind of got by even probably better than I was by not filing, and with the, failure to pay penalties and things of that nature. And so if somebody came up to you and was essentially trying to figure out where they needed to start, what would be like a maybe 3-step plan to effectively start taking care of, 1, their finances, and 2, their taxes?
Taking care of like tackling the back taxes?
Yeah, we can start there.
Well, so if you're gonna tackle back taxes, you made a great point. Don't wait till it's too late. Reach out to somebody, even if it's just to get pointed in the right direction. Most people, most accountants, even if you don't become their client, they're going to offer some kind of general guidance to get you on the right foot going forward. The worst thing you can do when it comes to back taxes is waiting till it's too late. Because here's what's happened over the time. When you don't file your taxes, so for example, now it's 2023, somebody that didn't file 2021 taxes and they still haven't, if they have a balance due on their tax return and they just neglected it, not only will you pay the taxes that you owed, but there's a 5% late filing penalty every single month until you get to 25%, and it caps. There's also a late payment penalty of 0.5% every single month that tax liability is not paid to the IRS. And some states are different, but the IRS. So if you wait long enough, you're looking at almost 47.5% of your entire tax liability tacked on as penalties. And let's not forget that there's interest every single month that accrues on that stuff. So the worst thing you can do when it comes to back taxes is wait and don't tackle the situation. Even if it means just filing a tax return as best as you can, you're gonna avoid late filing penalties. You can always amend it. You can always do something to go back and correct it. But reach out to somebody. If you found me on Instagram, just finding somebody and sending them a quick message and say, here's the quick situation. Can you point me in the right direction? Can you work with me? What are your rates to do this? So that's number one. It becomes difficult with back taxes because most people, as that year was progressing, when it came to filing, oftentimes they didn't prepare to pay the taxes. And now that the tax deadline has passed, they also may not have the funds to go back and pay those taxes. So you just put yourself in a much worse position by not filing your taxes, by not seeking help. And honestly, it's unfortunate, but it is common. A lot of clients do come to me with back tax issues and they just haven't filed. And maybe that's just human nature. But it does happen, and most accountants, most people will want to help you. They will want to kind of set you down and tell you at least the right direction to go into, or just help you out. So that's kind of the back taxes part. There was another part you wanted me to tackle.
Got you. I'm gonna actually just stay there, as far as finding somebody good to help them out. Because I know for me, also in the past, and I think a reason why I got so discouraged was that I would ask someone to recommend me to a CPA to help me with my taxes. And like, I would have the initial conversation and it would be fine and it felt like everything was on track. But then maybe like a month, two would pass and like the communication would just break. What are some like good signs of a good accountant and things that you do to make sure that people know that you're on their side?
Well, if you reach out to an accountant, the number one bad sign is if you just have to have a consultation with them and ask some general questions, and there's a price barrier to do that. So I do see it a lot where it's like, hey, pay me a couple $100 to have a 1-hour consultation with me. I mean, that's maybe one style of business, but I would stay away from those types of individuals because you're almost paying and you don't know what kind of guidance you're going to get. So if it means reaching out to a couple people, a couple accountants, so be it. But the things that you want to look for is when you hop on that call with your accountant, with a CPA, an EA, a tax preparer, how willing are they to actually help you? Or is it just about the money? Is it just about getting you as a client so that they can get paid? And you'll know just by the feel of the conversation. So as you're asking questions and as you're seeking guidance, is the CPA guiding you in the right direction? Are they giving you tips on, how we can go about this, what you could have done? Are there ways where perhaps we can get you out of penalties and interest? And another big one is the right CPA, the right tax preparer will go more in depth into the situation. So if you come to them with back tax issues and you're a business owner, are they asking you the right questions of, well, how are you set up? Are you an S corporation? What is your revenue? What is your expenses? How are you thinking about the future? Because number one, we'll handle the back taxes. We'll take care of that for you. But why do that just to put you back in the same situation as you were? So are you also listening to someone who wants to advise you and educate you on what you did wrong and how they can benefit you going forward? So you'll find questions of like, well, how much revenue did you make? What were your expenses? How's your business going? How are you structured? Are you just an LLC? Are you an S corporation? Are you doing this? Are you doing that? A lot of CPAs that are familiar perhaps with an industry, they'll go so far as to even ask questions about, well, I'm familiar with your industry. Are you doing this and that? And so the right CPA, especially nowadays, is more than just somebody that can punch in numbers. Anybody can punch in numbers. TurboTax is fantastic. It's only getting better. So the right CPA, the right account is somebody that genuinely wants to help you, wants to advise you and educate you on what's going on. And they're not in it just to get you as a client. They're genuinely in it to help you, provide you guidance. And whether you work with them or not, they know that they've helped you, get on the right foot going forward. So as you're having these conversations with an accountant, with a CPA, keep in mind the things that they're asking you. So is it just quick conversations, 15-minute call that, hey, how are you doing? This is the situation. Okay, it's $300 to do this. We'll move on. What did you get out of it? Or are you sitting with somebody on the phone that's asking you questions for half an hour, 45 minutes, an hour, really understanding how you came to be in this profession, in this business, how you've developed it, what went wrong, what can be done, and also how can we propel you forward? So the right CPA is an advisor, first and foremost. And that's where our profession as accountants is heading. We need to be advisors for our clients to make sure that they're not repeating the same mistakes. Because I'll be honest with you, tax preparation isn't the hardest part of our job. It's tax planning. It's working with your client throughout the year. Come tax time, that should be the easiest part for any CPA because we've done all the work throughout the year to get you to this point. You feel comfortable knowing what you're gonna pay. I feel comfortable that I've advised you, and now we filed that tax return to say, well, just as we predicted, here's how it ended up just as we thought.
Got you. Yeah, okay, so going back, we talked about the back taxes 3-step plan or what to do in order to plan it. As far as a new client comes to you and they want to just know which direction they should go into. And I know every situation is different. But what are some general things? Because everybody can't necessarily afford someone that they can pay monthly. So what are some of the guidance things that you would lead people to make sure that they're taking a step in the right direction?
It comes down to assessing where that client is. So you talk about potentially a small business owner that has a well-established business. They're going to be in a much different situation than somebody who's just starting out. And so having to, put somebody that's just starting out on a, paying you monthly to work with them may not be the best option for them. So for example, if somebody comes to me that maybe is just starting out, they don't have that small business established, I'm not going to try and sell them on some monthly services. I already know that that's not where they are. Maybe I might tell them about it for the future when they get to that point, but it's general tips and guidance just to say, here's kind of where you are. It may not even make sense to work with the CPA, but here's what you can do to set yourself up for success. Are you tracking your revenue? Are you tracking your expenses? How are you saving for taxes? Are you paying down debt, bills? And I feel like nowadays with software, I have like QuickBooks, for example. Everybody is on QuickBooks, and most people that come to me with a QuickBooks file usually isn't the best file, because Intuit, the company that owns QuickBooks, isn't in the business just to sell QuickBooks to accountants. They're in the business to sell QuickBooks to anybody that wants to pay for it. It's a monthly subscription. And so they don't care how you use it. They just want to sell it to you. And so I've even deterred people away from going into software. If you're just starting out, pop open Excel, pop open Numbers or Word, and just track things manually. You have a credit card statement. Here's your revenue from the clients. Here is all your expenses. So come tax time, it's relatively easy for you to do your taxes. The number one tip that I can give you is when you do open up a business, when you open up that LLC, go to a bank, get a business bank account, get a business, a debit card, a credit card, and keep things separately from your personal life. And the reason for that is it makes tracking a whole lot easier. Most credit card companies' statements nowadays have an annual summary, so it makes it very easy for you come tax time to put in your revenue, put in your expenses, and do your taxes. So it's like if somebody comes to me and they're just not ready to truly work with the CPA, I'll still provide the guidance for them to just get them on the right foot. And a lot of times that just sometimes means simplifying the process that they're using for taxes, because not everybody needs QuickBooks, not everybody needs payroll or anything, so fancy invoicing systems. So, yeah.
Okay, so let's talk about tax write-offs. I feel like this is probably one popular topic of conversation when it comes to taxes. It's just like, oh, I'm going on a trip, I'm going to write this off. Or essentially, I feel that a lot of people think that everything is a write-off. And some things are and some things aren't. What are some things that people should really, or what is a good rule of thumb to know if something is a write-off versus if it is not?
That's actually a great question. So a good rule of thumb, and this is this is the technical answer that the IRS gives you. A business expense has to meet two criteria. Number one, it's ordinary in nature. So ordinarily it would be used, it makes sense for the business. And two, it is necessary. So if you generally can meet the two criteria of, hey, something that I paid for is both ordinary and necessary to my business, oftentimes it will be deductible. So for example, you bought this table, right? Ordinary, necessary expense for your business. Your trip to get here, have a home office, your trip to get here from Uber or you drove here would generally be deductible. You are going to a business event. If you're just going and traveling for personal reasons, that's not deductible. But general rule of thumb is it has to be both ordinary and necessary in nature. Let's keep in mind industries as well. Different industries, different deductions. So for example, I'm an accountant. I do a lot of video calls, a lot of face-to-face meetings. If I did hair and makeup for myself before every meeting, that doesn't really mean it's not really an ordinary and necessary expense to my business. It almost doesn't make sense for my profession to be doing hair and makeup. Now, if you're a model or you're doing cinematography, photography, that hair and makeup that you're for your clients, if you're putting on a photo shoot, that's very likely deductible because it's both ordinary to your job and it's necessary for that photo shoot. So different industries have their own deductions that make sense that also don't make sense for other professions. Common or great business deductions are a home office is always a fantastic one that a lot of people don't know about. So if you have a separate space in your home, the square footage of that space to the total square footage of your entire home, you can write off certain deductions. So if you pay $2,000 of rent a month and your home office space, if you have a $100 little home office, 100 square foot home office and 1,000 square foot home, 10% of your home is for business purposes. That's what you use it for. So if you pay $2,000 of rent a month, $200 is a business write-off. So same goes for utilities that you pay for your home. If there's any like direct repairs or maintenance to that home office area, generally it's deductible. Generally repairs and maintenance to that entire home, if they make sense as a whole, like HVAC, plumbing, electrical work, generally benefits the entire home, so you can take that 10% to that deduction. Same goes for mortgage interest. Property taxes is another one. Great deductions are auto mileage, auto actual expenses. So when you purchase a car, there's the potential for a phenomenal depreciation deduction on that car. Depending on the type of car you bought, there's a greater deduction or a lesser deduction. Again, depending on usually the vehicle weight. But there's also just standard deductions. So if you drive for business purposes, if you're driving to like photo shoots or stuff, the gas that you pay is deductible. If you have to rent, for example, a van to haul equipment, that's a business expense, ordinary and necessary in nature. Auto mileage is another one. So tracking your business mileage is fantastic because what the IRS does is, let's say that you drove 1,000 miles for business purposes in a tax year. Well, they'll give you a mileage rate that you can apply to those miles as a business deduction. So I think for 2023, it's 62.5 cents per mile. So let's say you drove 1,000 miles for business, $625 is a business deduction, right? You can either do actual mile or actual auto expenses or auto mileage, whichever is the greater. There's some more rules, but general rule of thumb. Other great deductions, promotional expenses. So you can't write off entertainment, unfortunately. So going to like the Cubs game or something, that's no longer deductible. But if like you put on a workshop, if you're putting on like a podcast, that is a deductible expense. The time and the resources, the stuff that you paid for to set this up is deductible. If you happen to buy meals for this event, that's deductible because you are feeding. I saw that pizza, you know? So if you bought meals for this event, that's a deductible expense because you're feeding the crowd, you're feeding the audience, and even yourself for a business purpose. Some other ones, I wrote this down, is continuing education is one that a lot of people forget, especially when you start off in freelance. When you start off as a business owner, you don't know everything right away. And there are professionals that you can go to, and they oftentimes have workshops or classes that they put on. Those costs are deductible. They're ordinary. They're necessary in nature to your profession. Now, if you decided to go back into, get a master's degree in something, that's tuition. Whole different field, or a whole different topic. But stuff like continuing education is a great deduction. A lot of individuals, once they become 26 years of age and over, they have to start paying for health insurance. So you get off your family plan. Mom and dad aren't going to pay for this anymore. You have to pay for health insurance as a freelancer. That's a great deduction. That the IRS does allow that as a deduction. So there's a whole slew of deductions available to you, and you just got to remember, industry specific is another big one.
Yeah, I remember in college, because I was a cinematography major, they were just like, if you go to the movie theater, it's a write-off, essentially, because it's essentially kind of education, I guess. And you can tell me if I'm wrong or not. But that was something that they mentioned, and granted, you go to the movies, you spend like $15, but something that they talked about. Now, another thing that I also have questions about is like traveling. So I travel sometimes for work. Some things are covered by the client, some things aren't. But in the case, and this is just an example, in the case that I go somewhere, and I happen to be shooting while I'm there, I'm being paid to shoot while I'm there. What's the process on that? Is everything that I do while I'm there considered a write-off, or are there like some thin lines?
Well, you gotta know what you're paying for. So you gave the example of you're going to a different state, for example. If you drive there, potentially those miles would be deductible. Let's say you fly there, right? Those airline tickets, if you're going for business purposes, and if you can document and show that I went for a photo shoot on this day and that day, that travel expense of those airline tickets is deductible, 100%. If you have to rent an Airbnb, if you have to rent a hotel room to stay there, that's deductible. If you have to somehow pay to get loads of equipment into another state, that's deductible. I mean, there's again, it's ordinary and it is necessary for your business. Now, if on that same day with your clients, you decide to have lunch and dinner, that's deductible. Let's say on the second day, you and a significant other, or you and a friend decide, hey, like, let's go check out the town. Like, let's just go, let's book a tour for something. Let's try this restaurant. Let's try this event. Well, now it's really personal reasons. And so those expenses that you paid for those personal events, I wouldn't write those off. But you went with the purpose, with a business purpose, and those expenses associated with that are deductible. So even flying back to your home state, that's deductible. Taxis, Ubers to drive around, deductible. I mean, you really have to look at it and say, what is the nature of this travel? Am I just going for personal reasons and I happen to find a little business shoot? That travel that you wrote off to go on vacation, which you maybe did a little bit of business on because you opened up your laptop, responded to some emails, that's not deductible. You went for personal reasons and you just happened to, utilize technology for your benefit and responded to, some business inquiries. That's personal vacation. That's not deductible. But when you look at your trip and you say, what is this really for? And if you can prove that this is for business purposes, I would make the argument that that is definitely deductible.
Got you. Cool. So at the end of each episode, we essentially just ask our guest if they had the world's attention for 30 seconds, what would you say?
If I had the world's attention for 30 seconds, I would say that it is more blessed to give than to receive. And what I mean by that is when we focus on giving, when we focus on helping in our business, in our personal lives, we make the world a much better place. Oftentimes, we start things, we tackle on new ventures with the notion of, what can I receive from it? How successful can I be from this? How much money am I gonna make from this? When it comes to helping out a client, a friend, the thought does cross your mind, like, what am I really getting out of this? Like, what is my benefit? And when we develop or create a world where giving is the primary thing and receiving, it doesn't matter what you receive from it, you just create this world where there's compassion, there's love, and people genuinely want to see the success of others, sometimes even at their own expense. So that would be my message to the world. It's more blessed to give than it is to receive.
Got you. Does anybody have any questions that they would like to ask Alex?
So one of the pillars you mentioned for financial success was investing. So I know that's a beast in its own, but for someone starting out, what would you recommend as like starter tips?
Starter tips. So investing, if anybody's just starting out in investing, you're going to get it sucked into this whole world of, should I open up an IRA, a Roth IRA? Do I have a 401k? Do I put my money in crypto? If you're just starting out, very likely the best thing available to you is an IRA, is a traditional or a Roth IRA. Depending on where you are income-wise, one is allowed, the other may not be. But assuming you're somebody that's just starting out, maybe you're not making too much money, a Roth IRA is one of the best options you have available to you. The reason why is what happens with a Roth IRA, and this is also applicable to a Roth 401k from your work as a W-2 employee. When you invest money, so a Roth IRA, you are allowed up to $6,500 a year. That money you put into it, it's not tax deductible, but that money compounds annually and grows for however many years until you take it out for retirement. When you take out that money for retirement, it's not taxable. So that $1,000 you put in, that $6,500 you've been putting in year over year, not only has it been growing tax-free, but it's been growing tax-free, and when you take it out, there's no taxes to pay on it, and so that's just another thing during retirement you don't have to worry about. Traditional IRAs, a little bit different, where you do get a deduction now, but when it's time to take out that money for tax purpose, in retirement, it is taxable to you. So if you're just starting out, focus on retirement, focus on an IRA. If you are employed, talk to your employer, utilize that 401k that is very likely available to you. And the great thing about a 401k is your employer will often be required to put some percentage on your behalf as well. So if you take 10% of your pay stub every 2 weeks, your employer once a year may do up to 3% and match it for you. So you're just getting additional compensation. You may not have it now, but it is going to your retirement. If you're already maxing retirement accounts, another fantastic one is put money in the stock market. We look at it now where everybody's scared of the stock market. Stocks are falling and then rising, and you look at all these headlines and you start to get worried that there's nowhere to put my money. If you look at history over the past 100 years, stocks go up. And so there are these peaks and valleys in the stock market, but over time, your money grows. And that's where I would start. I always say this, if you don't know something, don't put your money into it. So unfortunately, I did see a lot of downfall with friends and clients in crypto when I was told to invest. And it's unfortunate. If you don't know it well enough, don't put your money into it. But Roth IRAs, traditional IRAs, 401ks, they're generally a safe investment. And if you're not doing them, get on it, because it's just going to benefit you in the future. You're very welcome.
Cool. Well, thank you for coming out. This was a great episode, and I feel like I learned a lot. Let's give it up for Alex.
Thank you.
And where can people find your social media?
You could probably find me easiest on Instagram. It's at Alexon Financial. I'm on LinkedIn. You can go to my website at alexonfinancial.com. Instagram's probably the easiest. I feel like a lot of people are very familiar with it.
Okay. And you can also set up like video chats with Alex through his website and get in contact through his website and everything too. But yeah, thank you so much.
Very welcome. Thank you for having me. I'm honored.
Cool.
Right on.
Cool.